taxation authorities, if you talk to the investors, etc., everyone has a different understanding of the extent of work the auditors do and extent of responsibilities that they have in terms of the financial statements. Now, if you talk to, God forbid, if you get to some interaction with NAV or accountability kind of authorities, and they're looking at the financial statements and the role of auditors, they have an entirely different set of expectation as to what the auditors would have done in the audit. They would believe that if something is audited, it means everything which is contained in the financial statement is looked at by the auditor, and they do audit of all transactions, and they should be aware of all events, etc., and etc. They have, in their view, they have a different meaning of audit. Whereas you talk to regulators, they again have some expectations which are beyond the auditing standards from the auditors. If you talk to taxation authorities, they have a different feeling about the audit. Now, if we are communicating as part of our report that what we do and what we are required to do as auditors under the internationally accepted standards of auditing, then I think it will help bridging this gap to some extent, because at least we are describing to the public at large that what we do normally and what we are supposed to do, and on what basis you should rely, therefore, on our report. So the audit work should not remain a mystery as currently it is, because a lot of work that we do is buried in our working paper, is not visible through our reports, is not the insights, the evidences that we gather, the kind of procedures that we deploy, etc., and etc., remain with us. They are not shared with the users of the financial statements, people who are relying on our report. So this is the idea, that the auditors should be more transparent about the work that they do and should describe the entire audit process in a greater detail, and also describe what factors they have considered in reaching to the opinion. Okay, so this is the form of the new auditor's report. There is certain shifting in terms of the sequence as well. As you know, previously, we used to start with what we have audited, describe the scope of the audit, and then in the end, reach to a conclusion and opinion about the financial statements. Now the opinion, which is the bottom line, will be placed as first paragraph. That what is in the first paragraph, we will describe what is the opinion of financial statement overall, whether we are happy with a true and fair view or not, and then we'll go on the basis of our opinion, that what work that we have formed in reaching an opinion, and then describing the uncertainties and key matters, and also the key audit matters which have been considered in forming an overall opinion, and then auditor's responsibility section and management responsibility section. So this is, as you say, there are two components of the audit report. One component is the auditor's report on the financial statements, which is what the auditing standards or require us to report. And the second is report on other legal and regulatory requirements. This is a second part of the auditor's report. That part is because we have to comply with the company law requirements and obligations to give specific opinion about certain matters. Like I said, books of accounts have been properly maintained, and accounting policies are consistent and so, and all expenditures have been incurred for the purposes and objects of the business, etc., and etc. Those specific reporting requirements will be met through this specific section, which is a second part of the auditor's report. So, this is regarding the form of the auditor's report. Now, let's try to deep dive into the key audit matter area, that what are the key audit matters and how the key audit matter reporting, what implementation challenges, what issues, and how we should approach the key audit matter reports. As I said, they are defined as those matters in the auditor's professional judgment. Professional judgment is extremely important, as of most significance. And there are three indications of identifying something as a key audit matter. One, something which is a significant risk So this is not a new term. I think as auditors, we are required to identify and make a risk assessment at the very start of the audit and identify what are the significant audit risks that we need to address in a particular audit. So those significant risks typically may be a key audit matter. Significant risk is defined as a risk which has a greater possibility or magnitude in terms of the misstatement to the financial statements, or risk of misstatement to the financial statements. So significant risk, all significant risks that have been identified in an audit should be considered to be the key audit matters. The second is significant areas of judgment, like impairments of assets, the provisioning in terms of contingencies, the areas which require a lot of judgmental analysis by the management in order to do the accounting or estimation is also an important area, because that is subject to, again, a risk of misstatement because of the judgmental bias that the management can exercise in making those decisions. The second important area is significant judgments and estimates. And the third is significant events or transactions during the year. The significant events or transactions during the year could be like acquisition of a new business, or selling of a portion of a business, or discontinuation of a business, or any other major, say kind of enhancement in the capacity of the plant, etc. So you can have significant event or transaction as a key audit matter as well, because they are so important in a particular year's financial results that they need to be highlighted and should be given a lot of focus by the auditors in reaching the opinion. So there are three things: significant risks, significant estimates, and significant events and transactions during the year. Interestingly, under the new fourth schedule and fifth schedule introduced under the Companies Act, a specific disclosure is also required by the management of all the significant events and transactions during the year. So in that section of the disclosure, the management has also to describe each year what they consider as the significant event or transactions for the year. And our key audit matter naturally should correspond to those events as well, because it will be very difficult where a management is convinced about a significant event or transaction that this is something which is significant, which has occurred during the year, and we as auditor ignore it in our key audit matters in the auditor's report. So that has to be kind of compatible with the disclosure provided by the management. So if you think about key audit matters, I think significant risks, significant estimates, and significant events, then you may be able to identify events like, for instance, going concern as an assessment, maybe a significant risk, revenue recognition, maybe significant judgments involved in the way revenue is recognized, new accounting standards, changing in accounting policies, again, a significant event for the year, impairment of assets, significant judgments required, valuation of financial instruments, complex instruments, sometimes valuation techniques used, not widely used in our market like derivatives, etc. But sometimes those can be complex and again judgmental. Retirement benefit plan, long-term pension plans, and other post-retirement plans, because they're subject to a lot of assumptions about the future. And the more you're looking towards the future, the more uncertainty you're accepting, and the more risk that you're exposed to. So if you have material post-retirement benefit plans, particularly pension, then I think it may qualify as a key audit matter as well, depending on the materiality and the impact of those post-retirement plans on the financial statements. It is particularly true in case of large public sector organizations where there are huge number of employees and complex pension and gratuity plans and medical plans, etc. Business combinations, certainly a very important event for any period. Deferred taxation, I think that is a complex area. Normally, entities depend on auditors to work out deferred taxation, and that actually, again, needs to be explained if deferred taxation is subject to future uncertainties like future projections or financial projections about availability of profits to set off losses, etc. Or there are other complexities in the way deferred taxes are set up or would realize. Again, I think it may be a key audit matter. Contingency provision, the decision about whether it is probable the outcome of the decision is likely to be in the favor of the company or not. Again, you have to rely on the experts, the legal experts, and sometimes, and in making that judgment, I think it potentially could affect the financial statements materially if you go wrong in making that judgment, and therefore contingencies in most cases is also a key audit matter. So these are some of the examples of typically what key audit matters we are talking about. But I'm sure there are many more. Like there are many more which may or may not have a direct reference to the financial statements. Like in some entities, you're heavily relying on the IT infrastructure and controls. In some entities, there is a, say, new ERP transition or implementation. So you're moving from one core ERP to the new ERP system. There are a lot of migration of data from one set of system to the other set of system, and which has its own risks, etc., and which therefore may qualify as a key audit matter for the auditor, because that would entail a significant risk and therefore require much of the auditor's attention. There may be situations or entities which are dependent on IT infrastructure heavily in processing the information, and as auditor, you rely heavily on the controls which are IT driven. In that case, maybe the IT controls, how we have audited the IT controls, may become a key audit matter, because if end-to-end IT sophistication exists, so a lot of procedures are automated, and how you audit the automated controls becomes key for you in reaching your conclusions. So there could be key audit matters which are not referable directly to the financial statement items, but they are important in the process or a key audit matter because they are important areas of work which have helped you in reaching the conclusions that you have formed in terms of the overall opinion. Now, in terms of the process, I think the standard provides some guidance about the decision-making process, that you should start off by thinking that what have you communicated to the board in the past. So those matters which have already been communicated to the board in terms of the letter to the board or the presentations to the board in the previous period, these are the matters which should be the first set of matters that you should consider, and from there you should pick up those matters which are most significant and maybe a key audit matter. So a decision-making approach may be first look at what you have communicated to the board in the past, but sometimes I think there could be matters which skipped reporting to the board which are important, but doesn't mean that they should not be treated as a key audit matter in the current report. But it is just to help in making that decision that you should first start looking at the communication which have occurred to the board from the auditor in the past, and see if there are matters which are of so importance that it should be reported as a key audit matter in the reports. So key audit matter is a subset of the communication or the matters which have already been reported to the board. Or I think typically speaking, the board then is expected to be aware of the matters which will come as key audit matters in the auditor's report, because if you assume that all the important matters have already been communicated, so now when the new auditor's report will come to light, so the board and the audit committees may not be surprised at least about the subjects, but maybe about the content of the way the auditor's approach, or the way the auditor has described the key audit matters, may be a subject to discussion. Okay, so there is the standard also allows that in situations where the sensitive matters, where you have to weigh that there is a public interest associated with the reporting of a matter, and there is adverse consequences for the entity which could be severe if you report those matters. Now, those could be situations like where there is an investigation going on in an entity, and because of fraudulent circumstances or issues which have surfaced, and then if you disclose too many things about that event and also the actions the entity is taking, it may prejudice the position of the entity in the litigation or in the investigation, and it will have adverse consequences on the outcome of the investigation, etc. If there are such issues and circumstances, then the auditors are allowed to not to report something as a key audit matter. But I would assume that this will be very, very, very rare, and in those situations, the auditors are expected to consult with a legal expert that what if we report that matter as a key audit matter, and what could be the adverse consequences of public reporting of that matter. So that decision to skip a key audit matter reporting, I think, should be practically supported by a legal view that where a legal advisor or a legal expert believes that public reporting of that matter would result in adverse consequences for the entity that you're auditing. Now, if that is a view and that is a situation, maybe that justifies for the auditor not to report that matter in the auditor's report. So in terms of what to be stated in the key audit matter, there are 2 or 3 areas which needs to be described. A, why the matter is considered as a key audit matter. So the auditor has to first justify himself that why they believe this matter is a key audit matter. Is it a significant risk? Is it a significant estimate? Is it a significant event? Or there are other considerations which has resulted or in what are the factors considered by the auditor in exercising the professional judgment that these matters should be considered as key audit matters. So the first paragraph of the key audit matter should describe the basis for including that matter as a key audit matter. And the second is certainly most important, what the auditor has done about that matter, what audit procedures have been performed to address that key audit matter. Now, in describing those procedures, there again is a problem, because you cannot describe each and every step or work step that you have performed. You have to describe in a summary form that what key procedures have been performed to address specific risks associated with the matter. Now, if you describe that you have performed a number of procedures and you use technical jargon around those procedures, it will not be well understood by the users of the financial statements. So the purpose of the CAM reporting is to communicate more to the users of the financial statements, not in a technical jargon, but in a common language which could be understood by people who are reading your reports. So that is more important, because when you describe procedures, when we as auditors describe procedures, we use a lot of technical words, substantive, analytical, materiality, etc. and etc. I think, in my view, the CAM reporting is meant for the general public and users of the financial statements, and the purpose is to communicate what you have done in a very meaningful way. So if we have to increase the communication value, we should think about describing our work in more simple language rather than technical jargons. And we are required, the standard requires that we should describe only the procedures that we have formed. The standard is not making any obligation on the auditors to describe the outcome of those procedures. So we are not required to give results of all the procedures for each CAM. The results of the procedure is in terms of the overall opinion that has been expressed. So there are no separate opinions on each of the matter which are reported as CAM. The opinion is one. The opinion is on the overall financial statements. There are no separate opinions in isolation on each of the matters that have been described. And therefore, the standard is not mandating the auditors to share the results of procedures, but what they're required to share is to the kind of procedures they perform to address the risk. And the results is in terms of the overall opinion. And then the third thing, related disclosures. All CAMs should be referred to the relevant disclosures in the financial statements. Now, again, this requires a lot of rethinking about the disclosures, because if now auditors are reporting something as key audit matter and the disclosures around that matter are very basic, I think the management and the boards should reassess the adequacy of the information provided through that disclosure, because auditor's report is not the primary basis of providing information to the users. The primary basis of providing information to the users is the financial statements. So the shareholders or investors or anybody should not see the auditor's report as a means to that information. The basic needs of information should be met by the financial statements. The auditor's report only help understand more the financial statements and the reliability of those financial statements. So if there is a CAM which is reported, the disclosure should be more than the CAM in terms of clarity around the matter and in terms of how the management has handled that matter and what is the management kind of a position on that matter. So we need to carefully think the disclosures as well when we talk about CAM, and whether or not the current level of disclosures in certain situations would be sufficient when the CAM reporting kicks in. Now, okay, so as I said, I think there are some pointers which may be important. CAM is meant to be specific to the entity. Again, there are a lot of tendency in auditors to use standard wording. The auditors love standard wording. So looking for standard paragraphs so that it limits their exposure if they are using some, for example, auditors would love to use a standard paragraph around contingencies, but maybe in many entities contingencies may qualify as a key audit matter. So why not use a standard set of language to describe CAM around contingencies? But it is not the purpose. The purpose is to describe in the context of the specific entity that what are the contingencies and what are the risks associated with the specific contingency, not in general the contingencies. So the CAM is expected to be specific. The CAM is expected to highlight the specific issues. CAM is not expected to generalize the issue. So for instance, if there is a company where there are two main tax issues which actually are part of the contingencies, and the management believes those tax cases will be decided by the relevant authorities in their favor. Now, the auditor, if he believes that this is a major uncertainty and there's a major decision and judgment, then in that case, the CAM should describe something more specific to those cases. What are the issues involved, and what is the position taken by the entity, and what procedures specifically the auditor has performed to address those uncertainties and the risks and gain comfort around those contingencies. So journal statements and journal kind of reporting of CAM is something which should be discouraged. And number two, CAM is not a qualification. I think this is takes a while, a bit of educating clients, educating regulators, etc., because they are used to looking at a very brief kind of audit report where if the auditor puts one qualification, I think it gains a lot of attention, that an additional paragraph has been inserted by auditor, whether it's an emphasis of matter, whether qualification. Now there will be a lot of paragraphs inserted by the auditor in the report. So people who are not aware of the changes, I think, may take it very negatively, that why, what has compelled auditors to write so much? And therefore, there's a lot of education required for people who are reading the financial statements to understand that this is not a qualification or an objection raised by the auditors. This is not an objection, this is a key audit matter which has been considered and addressed by the auditor through the procedure. So this is not an objection, this is not a concern, this is not a qualification. And as I said, it's not a substitute for the disclosure. So the management cannot turn around and say, look, okay, we skipped that disclosure, but this is otherwise talked about by the auditor in their report. So auditor's report is the auditor's report. The financial statement, as I said, is the primary basis for providing information to the users. So the auditor reporting can never replace the requirement of disclosure or providing primary information to the user. That is the responsibility which is with the management and should remain with the management. So again, these could be kind of confusions which may arise as a result of CAM reporting, that people may start thinking about CAM as a primary way of gaining insights about the company, etc. There's no major change in the scope of the audit. There is no change in the standards which deals with the auditor's procedures. We still are required to do the same level of procedures with the same responsibility, but what has changed is the reporting of those procedures. So the story has to be told as well from the eyes of the auditor rather than from the eyes of the management. So it's like, it requires, again, a lot of engagement with the management. It requires a lot of input from the audit committee as well, because on one hand, the auditors are reporting what they believe are the key audit matters, but the audit committee and the board report should also touch upon those matters as well, because there is a requirement under the Code of Corporate Governance that the audit committee is responsible for looking at all the key audit issues and key matters which affect the financial statements. Now, typically in the UK, I think there is a requirement under the UK code that the audit committee is also obliged to make a report, like the director's report, to the shareholders about the work that they have done. I think I've seen in certain companies in Pakistan as well, where the audit committee also makes a report to the shareholders at the end of the year. In that report, I think it will be fair to expect that they will also talk about the key audit matters which have been included by the auditors in their report. Because for the audit committee, those matters should also be as important as for the independent auditor. So if an external auditor thinks that, say, so impairment of asset is something which is very important in a particular year, and they have paid a lot of attention in auditing that, so the audit committee report should also spell about that what they have done to make sure that they comply with the requirements of accounting standards in respect of impairment, and how they have discharged their responsibilities, and how they have gained comfort that the financial statement provide a true picture on account of impairment of asset or not. So in the UK, as I said, I think UK, the practices, the UK Corporate Governance Code was changed, I think much earlier, in 2012 or 13. They incorporated the concept of extended reporting, extended audit reporting, which is, the aim is the same as the key audit matter, and it more or less on the same lines as we have now in the auditing standards. And in the UK code, the audit committee is also required to report on all the significant issues considered by the committee in relation to the financial statements. And also, in the extended audit report, the auditor is required to describe all the significant risks, how the auditor applied the concept of materiality,